Welcome to UBP TV. This month's asset allocation remains heavily focused on equity markets. I'll talk about the other assets in turn. First of all, bonds. Our recommendation here remains unchanged. Keep duration very low. We remain focused on short-dated corporate credit, on short-dated high yield, and we continue to like non-directional bond strategies, which are flexible in terms of duration, in terms of credit quality, and which don't follow any benchmarks. Regarding convertibles, our position has done extremely well. There's been a very strong run in prices, which have risen far above the bond floor. And that means that yields on convertibles are today lower than those from the equivalent equities. So we're recommending to switch out of convertibles and into equities. On equity markets, we've had a great run so far this year, which has been driven more by re-rating than by earnings. In fact, earnings have declined since the start of the year in terms of forecasts. The next phase in equity markets is going to be driven not by re-rating, but by the pickup in the economy, which we think will feed into a better outlook for corporate earnings for the second half of this year and for 2014. Within our allocation, we remain focused on Japan, and we recommend taking advantage of the recent correction in prices to increase allocations to Japan. The policy setting from the Abe administration remains unchanged. The first arrow, monetary policy, has been fired, and that accommodation will remain in place. The second arrow, in terms of fiscal stimulus, is taking place. And the third arrow, that is deregulation and structural reform, will be fleshed out by the coming elections. So we recommend to increase allocations to Japanese equities. In terms of currencies, no change in our outlook. We like the dollar. We think the euro will weaken. We think the yen will weaken even more. And we believe that the Swiss franc will continue to lose its safe haven status and will weaken against the euro. So the outlook there is unchanged. Regarding gold, we note here again that gold's safe haven status is less of a factor in the market, and the price has declined from recent highs. The longer-term outlook, we believe, remains very supportive for gold, given central bank buying, given the impact of monetary accommodation on the debasement of currencies, and also given the fact that gold mining production is about to decline given the fall-off in terms of new exploration. So medium-term, long-term, the outlook is strong, but in the short term, we think there are better opportunities elsewhere, in particular in equities. And finally, hedge funds. As markets have begun to normalize, we've noted a gradual decline in the correlations between asset classes and between sectors, which have been extremely high. Also, the spike in yields that we've had, the fall in equities and the movement in currencies have translated into an increase in volatility. And for hedge fund managers, this combination of decreased lower correlations and higher volatility increases their opportunity set, and we think the environment is set for strong returns from hedge funds. Within this space, we like long-short managers, in particular those with trading skills, and also global macro. So to summarize, we believe that equities will be the asset class that will show the strongest returns this year, followed by hedge funds. We continue to like gold for the longer term, and to recommend that durations in bond portfolios be kept extremely low. Thank you, and see you next month.